This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The Fed delivers on what was expected, and now, over a week later, the market is trading lower than it was before that rate cut. What have you done for me lately? That's what stocks want to know, and this week we'll look at what some of the analysts make of these moves and what comes next. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. Although we've had a bit of a pullback this week, notably with some of the best performing stocks on the board pulling back from recent all-time highs, it still has been a month categorized by a risk-on trade. Maybe the pullback will manifest an actual technical correction from these lofty recent highs, a technical correction being they've been at pretty high prices and it's pulling back a bit, not because of any big major shift in the world. But according to a piece recently in the Financial Times, came out shortly after the Federal Reserve cut interest rates, quote, the rally extends across risky asset classes with the additional borrowing costs that high-grade U.S. companies pay over U.S. Treasuries dipping below 0.8 percentage points, their tightest level since 1998, end quote. Now, there are two possible takeaways from that. The first is that companies are now able to borrow today at a lower absolute and relative basis than they've been able to in many years. Not only are rates trending a bit lower, but the spread to the benchmarks is so tight, it's also a reflection that capital is seeking a home. Not only are stocks going up because money is moving into equities out off the sideline, albeit with a lot of cash still on that sideline, but also there's more thirst to lend today, as lenders are demanding very little premium over the treasuries for the additional risk that they would take on to lend to corporations. Also in that Financial Times piece, which cites analysts from multiple sources that assets are priced to perfection, they're saying, they go on to say, quote, according to Bank of America, global stocks saw their biggest weekly inflow of 2025 this week as investors cheered the first signs of looser monetary policy, end quote. And of course, I kicked off the show by pointing out that the market today is lower than it was before that rate cut, but this piece was from a couple of days ago. And while my story today isn't to fully align myself with that line of thought, that we're priced to perfection, that we should be changing course in some ways, that we should be radically contrarian, and certainly I'm not saying we should panic, as there are numerous tailwinds for risk assets today, which is contributing to this. One has to look at themselves, though, and consider, were they more likely to be adding cash to the portfolio, to add to risk assets when we were having that big sell-off in April, or are they more likely to do so today? Were you buying these very same assets in this same calendar year 20% cheaper or more than where they are today? Or are you willing to buy them today because you're more comfortable when stocks are going up? Well, the highly anticipated move by the Fed last week is expected to be followed by at least now four more interest rate cuts now that are being priced in by the futures markets. That's not what all the analysts are saying, but that's what the future trading market is pricing in. And that has sparked gains in short-term U.S. Treasuries, taking the 2-year yield down to as low as 3.5% this month. Sorry, the 10-year yield, close to its lowest level since 2022. Now, that's definitely a big boost for stocks. I referenced numerous times this year that the market was kind of hitting a wall when the 10-year yield was hitting 4.5%. But with the market now pricing in all these rate cuts, it may be time to consider whether your overall allocation to risk is, how much exposure you had there. Not panic if you're on a course that's based upon a solid foundation of a plan, but be prudent. If your allocation to risk to stocks is 10% or more above where you might have targeted your weightings, and meanwhile you're also looking for opportunities to add more, well, perhaps you need to be a little bit more choosy on price. Perhaps look for dips rather than investing more at all-time highs. That does sound like a lot like timing when you say look for dips, because it is intrinsically, but we also might be seeing that dip form right before us this week with this little pullback in the markets. Now, drawing again from the Financial Times, they cite Neil Kashkari. He's the president of the Minneapolis Fed, and he said that the labor markets appear to be slowing. At the same time, the risk markets seem exuberant, and any sign of new economic weakness could pop up in that exuberance. At the same time, or actually a few days later, because it wasn't part of that same piece, but Austin Goolsbee came out and gave a few comments. He's the Chicago Fed president, and he said that he did back the recent quarter-point cut, but he said that he could be less willing to support more cuts in the upcoming meetings, despite what the markets are pricing in and anticipating 4 more cuts. And it's a mixed message because he's saying that the softening jobs market is not a sign of a looming recession, which is good, but it's also not great if the market is pricing in 4 interest rate cuts and they don't get them. Goolsbee said, quote, "I'm uncomfortable with front-loading a lot of rate cuts on the presumption that inflation will probably just be transitory and go away," end quote. And this was supported by the GDP data that came out on Thursday, which is not a leading indicator, but it supports that the economy is on a reasonable footing at least, as the results exceeded all the estimates. At the same time, initial jobless claims came in below the estimates, meaning new unemployed was lower than expected, and it was below the previous period, although still above a kind of a benchmark 200,000 people filing benchmark there. Now, in reaction to this week's data, strategists published that, quote, "There have been notable cracks, especially in the U.S. labor market, but we've made it through another week without evidence of broad contagion coming across the economy," end quote. And while we're sitting at the dawn of this kind of era of this huge expansion in spending based upon the emergence of the AI boom, according to the Wall Street Journal, we're also trading at record high multiples in the markets in terms of at least price to sales. But the market, while expensive, is not trading at all-time highs in terms of price to earnings. But as far as what all these companies are trading at versus their sales, it's in unprecedented territory. And it's hard to believe this is just a revisiting of the dot-com type of bubble we experienced 25 years ago. And it is more or less 25 years ago to the day, right? But with the huge economic tailwind of this AI phenomenon pushing against the shift in global economic policy and trade restrictions, there's a lot of noise out there making it just that much harder for these pundits to have that much more conviction in what they're saying. And that being said, Goolsbee went on to say that while the impact of tariffs would be short-lived, he says that inflation is, quote, "now heading in the wrong way," end quote. So my takeaway is just hold your cards a bit closer to your chest right now. Enjoy the ride, but be careful with how committed you are. It's been a good year in the markets. If you came in fully loaded, we've had a few good years before it, you run the risk of being over-allocated to risk right now. And if you're committing more to it at this period, you need to be wary. David Tepper, he's one of the, I would say, one of the more notable hedge fund managers in history. Well, he said last week that he's not fighting it. He was given a cautious tone, but he says he's keeping his capital largely in as long as the trend makes it that much easier to make money. But he's reducing risk where he can because he has some very large positions that are hard to unwind. And he's basically saying he's keeping an eye on the door. Now, you might not be as nimble in the markets as he is, so be careful. While at the same time, focus on time horizon and not what the returns may be over any 1 or 2 quarters, which a manager like Tepper may be tuned into at any given time. All right, I'm going to run into a really short break here, but when I return, I'll give a much more thorough review of what the Fed did and what its consequences may be for the markets. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Higher inflation and higher interest rates could be coming, but bonds are still beating stocks so far this year. How should we think about positioning for stability and cash flow in a more volatile world? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Today's podcast is largely focused on macro and monetary policy, but the takeaway isn't to guess where we're going to put in perspective, where we're going to put risk, and how to think about it. How the amount of conviction that you have in the economy or the companies, it ebbs and flows, but its impact on your portfolio has got to be nuanced. How you react to these large headline issues has got to be nuanced and mitigated by your control of what you can control, which is a strong plan and having some semblance of a time horizon. Now, I own shares in and we own shares for our clients in both Apple and Berkshire Hathaway stock. And while I wouldn't try and guess what their shares may do over the next few months, we own them because we believe we have a conviction in their greater place in this world as well-run businesses, as companies that execute and deliver value for their shareholders over the course of many quarters to come, or maybe even years. Now, they're each excellent in their own way, and the ownership disclosure that I give here is intended to give you perspective that we're talking about them in a biased way, based upon our own opinions, and we share what the research from these other sources we have, and we share it to give you an idea of how we come to these conclusions. But today I'm mentioning them to give you a perspective more on timing and how you weigh those convictions that you may have versus controlling what you can really know, at least to a good degree. You got to know your timing and the application of risk in your portfolios. Now, Berkshire made pretty big news last year by greatly reducing their position in Apple. And there was talk, as there's always been talk over the years, of, well, maybe we should follow in suit. People say, well, he sold Apple. Should we sell Apple? But I think it's been a very good rule of thumb over years to appreciate Berkshire, appreciate what they offer as a company and as a shareholder, but try to avoid replicating their trades or to ride their coattails on them. Now, for some perspective today on that, Apple stock right now is at roughly $250 a share. And it's actually about even for the calendar year after clawing back some of these big declines it saw earlier, because it was trading as low as $170 a share. Now, Berkshire, maybe Warren Buffett or maybe someone on his team, saw a reason last year to reduce what was a massive holding of theirs. It was a tremendous portion of overall Berkshire Hathaway, a tremendous portion of certainly their stock portfolio, and they were the largest Apple shareholder. They're still the biggest or one of the biggest shareholders in Apple, but they hit a point where they decided to reduce their stake by about 70%, and they sold their shares over the past year from as low as $180 a share to as high as roughly $225 a share, when it's $250 a share today. And the point is, well, they made a tremendous profit. They still own a ton of it. And someone decided that it looked maybe fully valued, or maybe it had just become too big a holding for them. And the timing part is only tough if you function in the markets from a point of view of regret or let the fear of missing out rule your day. And it's not about Berkshire Hathaway or Apple, but how you deploy your capital at times like now in the markets, like April or today. Ultimately, it's very subtle, and a reasonable investor isn't going to make major shifts along the way, thinking they know what's right around the corner, but rather embracing the fundamentals of the good businesses themselves and the relative valuations at which they're offered at on the market. Now, getting back to this landscape that's before us, as you well know, the Fed did cut rates for the first time this year by 1/4 point. And the folks at Strategis pointed out the only dissenting opinion came from the newly seated Governor Herein, who voted not for 1/4 point, but his dissent was instead voting for a 50 basis point cut. And while I pointed out earlier this year that the market is now pricing in, early in the show, that the market is now pricing in 4 cuts for the remainder of the year, the Fed's actual dot plot showing where their collective brains are at pointed to 2 more cuts before the end of the calendar year. And while I cited 2 other Fed members who are recently sharing a more restrained opinion and looking to an otherwise healthy economy and dealing with the continued threat of inflation, the Strategis summary was more cautious on the economy and dovish on the Fed stance, saying, quote, growth in the private sector has slowed significantly. Some of this shift is related to a reduced labor supply in 2025, and it's structural, not cyclical, end quote. And we're hearing a lot of voices pointing to this as immigration has fueled the supply of labor in the country over recent years and obviously reversed this year, including now potentially a bigger impact on the skilled labor supply as the worker visa program is going under a major renovation, I'd say. But while Strategis says that the parts of the economy doing well is limited, and they admit that political uncertainty is creating economic shocks, they say, quote, looking ahead to 2026, the situation should improve. The recent passed tax bill should provide a boost. Deregulation should support activity, and credit conditions still look benign, end quote. And the historically low credit spreads is what I was referencing earlier. And the theme of a tariff headwind giving way ultimately to a tailwind from regulation reform is a theme that I've returned to on this podcast numerous times, starting back in late fall last year. What hasn't shown, but I guess maybe the slightest of green shoots so far, is the return of kind of a robust housing market participation. But home sales are picking up. We got some good data on it this week. And mortgage rates have certainly trended lower, well off their highs. And if that trend continues, well, we know the latent demand is still there. So the housing sector could start providing a good tailwind boost to the economy as well. Now, a look at the Goldman Sachs reaction to the rate cut shows that they focused on Powell's speech after the rate cut was announced, which was largely echoing his previous comments from the Jackson Hole speech he gave, that emphasized that while the supply of labor is reduced, demand, according to Powell, is falling off at a faster pace than that. In fact, Powell went on to say, quote, the labor market is really cooling off. They point out that the Fed believes they're acting here in a preventative manner, that they're not being reactionary, but they're being preventative ahead of when the need arises in the economy. Powell described it as a, quote, risk management move, end quote, and that they're addressing the risks more than the current needs. And Goldman says that historically such insurance cuts, as they call them, as they come in consecutive meetings, they are successful in quickly mitigating emerging threats. So they also expect a continued easing throughout the end of the year. Not really contrary to that, but another thought on it was JP Morgan's reaction. They were a bit more pessimistic on the economy, I guess, as they point out that AI investment has added 0.5% so far this year to GDP, but they expect consumer spending to weaken here due to the reduced purchasing power of the consumer, because the consumer is going to be feeling, we can't call it inflation, but the consumer is going to be feeling the effects of tariffs and what they call, quote, labor income softness. So the consumer is going to be paying more for the imported goods. The average consumer is more likely to be unemployed, I guess. So they expect consumer spending to show weakness. And they go on to look at the effects of rate cuts and what they have on stocks historically based upon different scenarios. Scenarios where stocks may not fare as well in a rate cut cycle when the Fed is cutting rates, fighting the effects of a recession. but also in what they call a quote, in a non-recessionary mid-cycle easing, like the current scenario, where equities and high-yield credit tend to perform well, end quote. That's what they think is happening now. They're echoing what Powell was saying, that they're being just getting ahead of the curve here, and they expect that to provide a big tailwind for the risk, equity, and credit markets. And that's echoing some of what I was saying earlier, and maybe for my last point today, J.P. Morgan went on to conclude that given the macro uncertainty, crowded positioning, and extreme valuations, they advise hedging downside risk. However, they view any near-term weakness as a buying opportunity, supported by low household leverage, easing monetary policy, and AI-driven earnings growth, as well as a weaker U.S. dollar. But keep in mind, they also dabble in some more esoteric than we may be, ways of investing than we may be comfortable with. You know, they might be putting kind of exotic hedges in on their portfolio, while they're also encouraging their readers, their investors, in response to this, to invest in China, Brazil, and Mexico right now. So while we may not necessarily be going down that road, I think that their overall outlook and what's driving that response is somewhat well thought out. Ultimately, I do think it's worth listening to what David Tepper has to say. He's got a great track record and he's got skin in the game. You can look up his recent interview on CNBC, but don't try to be as nimble as he might be. Although I think he also mentioned the complexity of exiting these very large positions, but try to focus more on exposure to risk. And I think this is a story I tend to tell in the fourth quarter almost every year for 25 plus years now. But focus on total exposure, enjoy the gains, but avoid the pitfalls of the fear of missing out by possibly taking the risk of taking a large exposure to risk and then doubling down when the returns seem like they'll never stop. Don't double down and chase greater returns because of that fear of missing out, but rather manage your exposure to it and enjoy what you have. That's all for me this week. I appreciate you listening in on the Wise Investor Show. Feel free to give us a call if you have any questions, and please, of course, share this with anyone else who you think may benefit from a basic common sense approach to investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.